quite a lot of flexibility within that fund. So we'll do mezz debt. So we'll do, secondary loans effectively. We'll do preferred equity as well. And we'll do a combination of current pay as well as deferred. And for your listeners, that might mean that the borrower may be paying, say, like an 8% interest rate that's current pay, but then maybe we get a back end equity split when that loan pays off. So we might get an effective 12, 14, 16% interest rate, but it allows the borrower to maintain cash flow during that period of time. So, we do well as an overall return, but we're also able to be flexible so the borrower can maintain their cash flow and make it an acceptable deal for investors.
Welcome, Real Estate Hustlers podcast. I'm your host, Josh Appelman. Today we're joined with Chris Larsen. Chris reveals how loss reshaped his path from pro-cycling dreams to building passive income, investing in cash flowing assets, using infinite banking to capitalize and on the upcoming real estate cycle. Chris, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, Josh, thanks for the opportunity to be here. Love what you guys are doing. And, Next Level Income was founded on education first. But yeah, you kind of alluded, I got my start in real estate at the age of 21, bought my first property. But really kind of the story leading up to that, I've had several losses in my family. I actually just lost my sister last year. But as I talk about in my book, which I'll share with your listeners how they can get a free copy, my best friend, he was also my training partner, my roommate in college. He died of a massive brain hemorrhage in between my freshman and sophomore years of college. And my dream at the time, I went to Virginia Tech, and I don't think you can see it in this shot, but I got my engineering degree up on the wall. I didn't go to school for engineering. I went to get a degree, but I wanted to be a professional cyclist. And I came this close to that dream. But what pulled me back was after the death of my friend, I raced for another year. I made it to what's called a Category 1 amateur cyclist, which is the level you need to get to take out a pro license. And my team actually went pro the year after I quit, but I walked away because I did a lot of reflecting in that year post my friend's death. And I just said, well, am I really going to be happy with my life if I've spent the majority of my free time, riding a bike around in circles, essentially? And the answer I came up with was no. I said, there's more to life. And I'd gotten a lot out of the sport, but it was going through some challenges in the late 90s. A lot of people know the story about Lance Armstrong. I got to train with Lance before he won the Tour de France. A lot of the professional cyclists at that time are either friends or, I got to race against them or train with them. And I wasn't good enough, Josh. So I often say, like, I wasn't good enough to make the choice whether to do drugs or not, because I didn't really have the opportunity that some of those cyclists did that had more talent. But the other thing that dawned on me was I didn't want to have any regrets. And I said, man, I feel like I have to live almost two lives, right? My life, but also to honor my friend Chris's life that passed away. I really wanted to pour everything I could into my life, and I didn't want to waste any days. And the realization I came to was that if you want freedom, you have to have money to do that. So I set off on this path to achieve financial independence. I was day trading in the stock market. I read over 250 books on business, finance, stock market, real estate. But ultimately, I decided that real estate was going to be my path toward financial freedom as somebody who didn't have a lot of money from a blue collar family, who was working my way through college and had a very minimal budget to do that. Which ultimately led me to that first property. And as of today, we've been a part of over $2 billion in acquisitions, starting with single family, but ultimately moving into commercial real estate and several other different avenues there.
Got it. Very cool. You packed it in there. So let's
and that was concise.
Yeah. I like it. Let's start with real estate. Your first deal. What kind of, just because the first one's, it really is, there's truly fear. So once you get past the first deal and then you prove to yourself it works, it's real, you can win, it grows from there. So tell us about your first deal, what it looked like, how you found it, and where you went from there.
Yeah. And if I may, you said fear, which I love that, because my boys play lacrosse, and a lot of times, I talk to him ahead of time. My younger son, he gets nervous a lot. And I look at him and I say, that's good. Like, those nerves are good. I mentioned we're closing on a deal tomorrow. And and I'm nervous because I'm like, oh, what about this? What about that? And that nervous energy, there's fear and there's nervous, and I think people say like, well, what are you afraid of? I'm not really afraid of what may happen, but I'm I'm a little anxious about it, and that those nerves are good because it allows you to focus on those things. And that's why I tell my son, I'm like, this means you care about this. If you don't have any fear, any concern, at some point you may be a little nervous, you may be a little excited. It transforms, right? Because we learn to identify it, and we learn to ask the right questions. We know what knowledge to get. But yeah, I was nervous buying that first property, but it was a little property. It was $90,000. It was a townhouse in Blacksburg, Virginia, where I went to school at Virginia Tech. And I couldn't get a loan myself. So my mom had to co-sign on the loan. I put only $3,000 down on that property, but then I rented the rooms out to friends.
Oh, nice.
And, I was managing that. So there was, it was a lot of different variables that had to be figured out, and every deal brings with it different challenges.
Mm.
And I learned a lot of lessons with that, but I had a very simple plan initially, Josh, which was just buy enough single family properties that I could pay off in 15 years, and I would have $10,000 a month after expenses and operate in net operating income that would pay my bills, and I'd be financially independent. It evolved. My plan evolved over the years to be a little bit grander and bigger, and do things. But that was how that first property got us started.
Well, and I think a part of the evolution is you find out what you don't know, and you find out that there's maintenance involved, and there's little things that
Yes.
it's like death by a million
Yes.
paper cuts.
Yep.
So kind
Oh
of
man. And I've got war stories like you wouldn't believe.
yeah.
So
I mean, every day there's challenges, but if there's not new problems, you're not growing. As long as the problems, it's never really the problem. It's the response to get the
yeah,
problem resolved. But
absolutely.
at the same time, too, if you're not growing, you're dying, and people around you want to grow. So, and for them to grow, you have to grow the company too.
That's
So
right.
it's
That's
forced
right.
growth. It's good. Um,
Absolutely.
so you got your first deal. You did your business plan. You got it cash flowing. What was the second deal? What was the
Yeah.
and then are you all what asset class are you primarily concentrating on?
Yeah, so I'll answer both those questions. So the first deal was that townhouse. I bought the one next door. So I
Okay.
talked to the owner, who was a friend of mine. I said, "Hey, when you're ready to sell, let me know." We negotiated a good price, and I ended up with 2 3 bedroom townhouses next to each other. So I was running my own little 6 bedroom multifamily property there, where I lived in one and rented out the other 5 units, and just continued to purchase single family properties from there. But what I realized, and this is kind of another loss chapter in my life, was when my mom died in 2011, and we're actually recording this on the day she passed away, 14 years ago. And I did an assessment, kind of look back through my life, and loss makes you reflect, is what I found, and kind of really determine what your priorities are in life. And when I looked at my portfolio, Josh, I realized I was making like 7% on my equity, and after paying tax, because I was doing well in my medical device business at the time, I was realizing like a 4% after tax return. Now, I also have an MBA in finance, and I'm thinking, like, I'm embarrassed, right? I'm getting a 4% return. Is it? And I'm like, I got a finance degree, like a master's in finance, almost a PhD. I was like, I gotta figure out a different way. So that led us to become passive investors in multifamily syndications. And then ultimately in 2016, we syndicated our first multifamily deal, which has been our primary asset class over the past decade. But also we have a private lending fund where we do hard money loans to single family investors. We also have a private credit fund where we do kind of mezzanine debt, and it's a little bit more varied than that for commercial properties. But our big asset class that we focus on the equity side now is senior housing.
Nice. I think
Yeah.
that is senior housing is indestructible. And I say
Well,
that with all
yeah.
respect because
Yeah.
you've got AI on the horizon, and how is that going to adversely
Yeah.
affect every single category? And
Yeah.
senior housing, to me, is a carved out niche that is it's there, and it's an any weather niche right now. I feel.
Yeah.
Um,
It's
we've
a
kind of,
need. It's a need, not a want, and
yeah,
it's very durable during all economic times.
yeah.
Although COVID hit it pretty significantly, but yeah, I'm happy to dive into that space as well.
Yeah, and I think that vouchers, anything voucher related, is going to be a strong asset class um,
Yeah,
here in the coming months too, or coming
yeah,
years.
yeah,
Very cool. Multifamily is definitely that's where we specialize in. It's what I love. It's plug and play,
yeah, absolutely.
and you're closing on a deal tomorrow. And I think that
Yeah,
nervousness is that it truly comes from what you don't know.
yeah,
As far
yeah.
as you find out what's the skeletons in the closet after you close, or a couple months after.
Yeah,
Uh,
what did Nancy Pelosi say? We got to pass the bill to find out what's in the bill. And people make fun of her for that, but it's one of those things like, yeah, you got to, it's like a relationship. It's like, oh, well, you'll find out about this person after you get married or after you have kids. It's like, there's some wisdom in that, because as you go through stresses with your partners and specifics with the deal, like you said, it's like you open up the closet and you're like, oh my gosh, I didn't like why don't we look in there? Look at the mess that we got to clean up.
yeah.
Um, and I'll give another example. Helene hit Asheville, North Carolina, where we live here last year. And I, the things that I thought I knew about risk just went totally out the door. For example, we own Airbnbs, and
Yeah.
if or let me give a better example. We own an office building. We actually just sold it, but we had 8 tenants. Well, I was like, we're fine, no damage to the building. We actually still had internet that we could provide, but there was no water and there was no power for a period of time. Well, if you can't provide utilities, you can't legally charge rent.
Oh,
So we were out rent, and we didn't have any business interruption insurance that kicked in at that point. Our property insurance didn't kick in at that point. The bank said, "Hey, you still have to make your payments. We can defer them, but that's still the city still wanted our taxes at the end of last year." So we were in this position where we actually had tenants that legally didn't have to pay us, but were occupying our property, and all our expenses were still going out the door. So again, it's like no matter how well you prepare, as Donald Rumsfeld said, there's known unknowns, but there's also unknown unknowns. And those are what typically get you, I found, in business and real estate.
yeah. Well, and we call around here we call it ignorance tax. We pay ignorance tax because, and
Yeah.
that's
Yeah.
why that's another reason why they say stick with what you know, because you get better the more you know
Yes.
about the
Yeah.
asset or that niche. Um, and then
Yeah.
learning a whole another vertical, learning the business, learning the nuances, all the things,
Yeah.
and then all the things. But it makes you
Yeah.
a much more versed operator,
Yeah.
and any weather operator you can, because we have Airbnbs as well, and extended
Yeah.
stay, multifamily, and
Yeah.
it's a lot, but it's all the same. We offer housing, so the core asset
Absolutely.
is still the same. So
Absolutely.
um,
Yeah.
let's so private lending insights is what our main focus was.
Yeah.
The credit fund. Tell us
Yes.
about how that's structured, how you got into offering something like that. Is it evergreen? Just tell us the things.
Yeah. Yeah, great question. So, your audience is probably accustomed to, hard money lending, which is what our debt fund is. But the private credit fund's a little bit different. So, we've seen the debt markets tighten up here over the past few years as interest rates have risen. So, in the commercial space, one of the challenges is your debt is basically determined by your debt service coverage ratio, the net operating income that a property produces. And as interest rates rise, you're not able to get the same leverage on these properties. So, you can have the same property, same occupancy, same gross revenues coming in. But in today's environment, where 4 years ago you might have had a 75% LTV loan from a lender, today you might get a 50 or 55% loan. Well, if you have, that means you have to bring more equity to the deal. As equity increases and returns are basically the same, all things considered, your returns are diluted, right? If you have twice the equity, for instance, you have basically half the returns. So, owners, ourselves included, they want to have the optimal amount of leverage to optimize returns for investors, but also not over leverage a property. So I'll give you an example. One of our borrowers with our private credit fund, they bought a smaller multifamily property in Georgia, and they were able to assume a loan at it was around the 3% range. I forget the exact figure off the top of my head. It might even been sub 3%. I think it was 2.9 now that I'm kind of thinking about it. But it only covered about half half the purchase, so or 40% of the purchase. So they said, well, if we can get this up to about 65% LTV, the numbers will work for us. But they needed that additional 20% of the equity in terms of a secondary loan. So we were able to come in, provide that little higher interest rate, but we're also lower on the capital stack. So that means that we're in front of the common equity investors there. Now we're behind the senior lender from the loan that they were assuming, but it allows us to get a more equity-like return, but be in a lender position with that. And what we like to explain to investors is it allows them to not only diversify across asset classes, but also diversify vertically in the capital stack. And I think that's something that a lot of investors have kind of been hit with in the past few years, is not realize you are away from that first dollar that's paid back in the capital stack. And that's why you see family offices, you see institutional capital, you see private equity groups coming in and providing like preferred equity or these mezzanine loans, because they can get better than say a 4 or 5 or 6% rate. Maybe they get an 8, 9, 10, 12% interest rate, but they're paid back first. Whereas if you're a common equity investor, you may be expecting a 16 or 18% interest rate. So this allows, not only us, but also our investors to diversify across that capital stack, also maintain a different level of liquidity, because these loans, while they're not paid back over, say, 6 or 9 months, like our hard money lending fund, they're paid back typically within 2 or 3 years. Yeah. So, there's also a cycle time that's different there as well.
Yeah, that 24 months is like and we still had a few units to go with renovating the units, releasing, and you get your performer rents on the second lease. So you take over the property, get rid of the bad actors, renovate, release, you come in on lower rent, and then your second lease is where you need to be. And typically a 24-month range is where you can pull off the refinance and get everybody made whole. Do you all participate only on like a mezz debt style? You don't participate on an equity, is that correct?
Oh, good, excellent question. We actually have quite a lot of flexibility within that fund. So we'll do mezz debt. So we'll do secondary loans effectively. We'll do preferred equity as well, and we'll do a combination of current pay as well as deferred. And for your listeners, that might mean that the borrower may be paying, say, like an 8% interest rate that's current pay, but then maybe we get a back end equity split when that loan pays off. So we might get an effective 12, 14, 16% interest rate, but it allows the borrower to maintain cash flow during that period of time. So, we do well as an overall return, but we're also able to be flexible so the borrower can maintain their cash flow and make it an acceptable deal for investors.
Yeah, and that makes sense. It doesn't starve out the property and to where it's just bleeding and then nobody gets paid, and it doesn't make sense for anybody. That's smart.
Exactly. Yeah, exactly. So, and these are all the loans that we do. I think this is, to be clear, in that fund are all performing loans. And we have control rights typically with those as well. So, there are some private credit funds that are out there that are targeting non-performing properties or those that are upside down on their debt. And that's another area, but that's not what we focus on.
Got it. You're looking for already stabilized properties that need an injection, or are they trying to get to the finish line on their renovation, on their business plan, or?
Yeah, it can be, we can come in before, like you were saying, like maybe on one of your properties, you say, hey, we need cash for 18, 24 months to get through our renovations and, get to a refinance. We can do it that way, or we can provide equity kind of once they're in the middle of it, but maybe they don't have as much equity as they needed.
Got it. That can help accelerate growth too. If,
absolutely.
I mean, real estate is so capital intense for good reason. I mean, it's all about basis. And if it pencils out to where you can truly have a capital stack that works for everyone and scale with that, I mean, that's a hugely effective tool.
Yes. Yeah. So we're trying to provide a solution for borrowers that are out there, owners that are out there, but also provide our investors with an opportunity to participate on the other side and be the bank, which I think it's a great time as interest rates are a little bit higher right now.
Got it. Very cool. What are some learning lessons that you've come across through the years?
Yeah. So kind of, staying focused on the private lending side of things, it's good to be on both sides, right? It's good to be the lender in some cases, but it's also good to be the borrower. If you own properties and do that, it's great, especially if you've got debt, 2, 3, 4%. We're assuming a HUD loan on these 2 assisted living facilities. It's 3.46%. It's phenomenal. 31 years left. So it's great to have that. But we've seen over the past 5 years, you could get bridge loans, you could put interest rate caps on there, and synthetically create a fixed rate loan over a period of time. The challenge is when interest rates go up 500 basis points, like we saw, the market changes drastically. So, one of the things that I've learned, and again, this is more like these black swan events. I've seen 9/11 when I was in business school. I saw the wall come down. I remember the S&L crisis because my parents both lost their jobs during that period of time in the early 90s. Saw 9/11, saw 2008, 2009. I followed that very carefully. Being in both the real estate and the equity markets as well. Then we saw COVID. So I'm running a medical device business at the time. All the surgeries stopped. The government said our tenants didn't have to pay rent on our multifamily deals, which I know, Chris, you probably remember that. And then seeing Helene hit. So all of these things, what I've learned is that, whatever your plan is, it's like Mike Tyson says, everybody's got a plan until they get punched in the face. And what I've learned is the world, the investment realm, will always punch you in the face one way or the other.
Oh, yeah.
So, if you're an investor, I look at it like you're getting in the ring. And if you get in the ring, expect to get punched in the face. You just don't know, where it's going to come from or how hard it's going to hit. So you gotta basically train for that. And what that means in the real estate space is you may have to carry reserves that investors are like, hey, what are these reserves for? You're like, I don't know. That's the point. Yeah. And I think that's a great question. So if you're an investor and you're asking an operator, or a syndicator about something, you can ask, you can say, hey, what are the risks you foresee? What are the downsides you foresee? But what I always tell investors is that, the risks I'm worried about are the ones that I can't really predict or tell you about. So I think it's wise just to be prepared to get punched in the face as an investor. But don't get knocked out. That's the point. Like, you might get knocked down, but don't get knocked out. Nassim Taleb says this. He wrote Black Swan, Anti-Fragile. He wrote these books, and he said, he talks about trading, and he basically says your goal as a trader is not to get knocked out of the game. Like you've got to have a strategy to survive. So that's the biggest thing that I've learned, Josh, is have a strategy to survive. And sometimes that means you have to pass up deals that are a little too skinny. They might work for other people that might get lucky. But we want to get lucky, but prepared to not be lucky.
Yeah, there was a post the other day I seen in the it was I survived 11 rate hikes, and it's so true. It was so true. It was. I
got to get that shirt. I want that shirt.
It was on a Christmas sweater, and I was like, that is so true. I mean, the amount of brain damage we all went through. I mean, just in the past, call it 5 years.
Oh,
but
man. Yeah.
I mean, we ended up we had a SBA 507 on our office that we built ground up, and the payment went from 10,500 up to 18,000 within 12 months, 12, 13 months. And it just became totally upside down, unrealistic. So we, of course, were fortunate enough to be able to sell that because it was brand new. I mean, it was 3 years old, but it was a badass office, but just forces, but like you said, don't get knocked out. You'd be able to pivot, stay another day. And then that ultimately opens up a new chapter as well of new growth. I mean, it's just like keep moving forward, keep going. But 11 rate hikes, I mean, how many guys were less fortunate out there that got stuck in the middle of it? And then I think we just did a refinance. We closed on Tuesday to get out of a short-term loan. I went through two banks, two appraisals, and still the first one was come to the table with 52 grand. The second one, we got it down to 16. So it's a cash in refinance. No investor wants that, but it's leading to the next phase in the market is values. So,
that's right.
And that again, we'll buy smaller properties sometimes at auction that we call them base hits. Just keep the crews going, keep the project managers going. But it's a great property, great location. But you have now values are not comping out to what they were even 12 or 13 months ago. So what is I don't know what the next wave is. I don't know what that means because in commercial it's totally different. We're values derived on income, which that's where we predominantly play to. But at the same time, just on the horizon, I'm looking at jobs. I'm looking at AI. I'm looking at buying power. And if your end buyer doesn't have the buying power, what
Yeah.
does that do for real estate values? So
Yes.
it's being
Yeah.
aware.
Yeah, I think we're in a kind of a sideways market here for a period of time. But I think there's a lot of opportunities out there for, like you said, like we're picking up this deal from an operator who's unwinding his portfolio. We just closed on a deal. I think it was last month, might have been 6 weeks ago, that we picked up 20% less than the seller purchased it for. Multifamily deal in the Houston market. There's opportunities out there. But the market has some pressures on rents and has some pressures on affordability, has interest rate pressures, has supply, fortunately, which is slowing down the multifamily side. But these are all headwinds that we face that are kind of turning into kind of calmer seas, and potentially some tailwinds here. So yeah, hopefully everybody that's listening has been able to weather the storm.
But it's a great time to buy
Looks like
too. It is a great
I,
time to buy. I mean, you're
yeah,
7, 8 caps on what we're trading at
yeah,
5.5, 6s. I mean, it's
exactly. Yeah,
and I think there's going to be more of those coming too, which
yeah,
is that's the play.
agreed.
Um,
Yeah,
for the listeners,
yeah,
if you knew then what you know
yeah,
now, how would your journey change in real estate?
yeah. Man, so I would have gotten into commercial real estate sooner. Certainly. We talk a lot about the 18 and a half year real estate cycle, which you alluded to in the intro there, Josh. There's a great book called The Secret Life of Real Estate and Banking that I recommend to people. I think that's a great read that talks about the banking industry in the United States, the history, but also by Phil Anderson, if you're looking that up, Josh.
I am.
But it also talks about the real estate cycles that we go through, and it's all based on credit, effectively, and land values. So I wish I knew that many years ago. And then one thing, we've actually been doing this for about 15 years. But again, I would have started this sooner. And it's when I talk to investors, it's one of the first things I ask them is, kind of the base of our financial period is cash value life insurance. And that's a real store, real safe place, to keep cash and reserves. And it's bailed us out a lot of times, during Helene, during COVID. We used to develop single family properties, and we would borrow from ourselves and then pay ourselves back. So that's a strategy I wish I employed earlier. I took out our policies 15 years ago, our first policies, but I didn't really start using those policies as part of my investment strategy until really in earnest, really over the last 5 years. So and we even have a website dedicated to that at Next Level Income /banking, or just click on the banking link. It talks about how we use our cash value life insurance policies to be the bank. Again, another way that you can be the bank and create a lot of value, but also a lot of safety for your family.
I know that those are not one policy fits all. If you're going to get one
No.
set up,
Yes.
someone like you, real estate
Yeah.
experience, because you've probably went through the
Yes.
brain damage of, wait a minute, this
Yeah.
isn't working out with, because I've heard bad stories about
Yeah.
it. I've
Yes.
heard confirming stories about it.
Yeah.
But it really truly does matter
Yeah.
of how it's set up
Yeah.
and who helps you get it set up.
Absolutely. So that's actually one of the reasons I got licensed during COVID, because I couldn't find a group that really understood how to properly structure these policies. And even though I had a couple policies that were well structured, my agent wasn't really giving me the best advice on how to utilize them. And it cost me, multiple six figures in opportunity because of that. So, that's what we help investors do is work with a group that can structure the policies specifically to what they're looking to do with them. And sometimes it's just, safety, guaranteed income, and retirement. That's one of the nice things with insurance is you can actually say, hey, there's a guaranteed face value. There's a guaranteed rate of return in these policies. Cash value in your life insurance is a great piece of collateral that you can use to borrow against. But you can still, utilize that on both sides of your balance sheet. But yeah, if you structure them in properly, you can kind of have a ticking time bomb that can go off if you don't use them properly, or you can pay a lot in fees. And that's what we do is we minimize fees and maximize cash value and structure for investors, so they're not stuck, with that ticking time bomb.
Yeah, very cool.
Yeah.
Awesome. If a listener wants to get a hold of you,
Yeah.
reach out, learn more about yourself, how can they reach
Yeah.
out?
Yeah, I mentioned, sorry, I should have mentioned this earlier in the podcast, but if you want to get a free copy of our book, Next Level Income, just go to nextlevelincome.com. You can click on the link there to get a free copy of the book. You can check out our banking resource, our life insurance resources under the banking page. And then if you want to learn more about our investment opportunities, click on book a call or the invest link, and you can learn about our private lending funds as well as our upcoming senior housing opportunities too.
Awesome, Chris. Definitely appreciate the insights. Look forward to following
Yeah.
you, and we'll talk soon. Thank you.
Thank you, Josh.
All right, bye.